Are you investing for retirement? Well, if so, you're going to want to stick around because today we are sharing 3 investment strategies retirees almost always regret. Hey there, I'm Johnathan Rankin. I'm the founder and CEO of Theorem Wealth Management, and I'm here to show you how you can set yourself up for a successful retirement. Now, right now is a very difficult time in the market. As of today, the market's down almost 24% from its high, and it can be extremely concerning to be an investor, especially when you're retired or you're planning on retirement. Now, this is money that you've saved for decades, and it's got to last you the rest of your life. Seeing major losses like we're seeing right now can make it extremely difficult to keep a long-term viewpoint on your investment portfolio. But after working with retirees for over 15 years, I want to share with you 3 investment strategies that I've found retirees almost always regret when they look back at it. The first strategy that they tend to regret is investing with emotion. Now, as I mentioned, the markets are down 24% from their high, and depending on what investment strategy you're working with, it could be a lot worse, as we see the NASDAQ or even the 30-year Treasury sell off much greater than the S&P 500 right now. Now, it's very easy to see losses and feel like the best thing to do is just stop the bleeding. But the dangers of doing that could cost you the large returns that you need in the future so that this money lasts your entire life. Take a look at this chart from Putnam. This shows investing in the S&P 500 from December 31st of 2006 through the end of last year. Now, if you would have just stayed the course, you would have netted a 10.66 annualized return. However, if you missed just the best 10 days during that time frame, 10 days, that's all we're talking about, your returns would have been cut by more than half. Now, you might say, well, Johnathan, if I see the markets going down and all the news around us is negative, then I can just sell out and I can miss those worst days. The reality is, even in good markets, there's always a reason to sell. For example, Ben Carlson put together this chart that shows all the events stemming from 2009 up through last year that talk about all the different catalysts that would cause investors concern. The reality is, the market continued to reach new highs. A lot of people think that they could just time the bottom of the market and invest when the market's rallying during the best days. But the reality is, if you actually look at the 10 best days during this entire period that Putnam looked at, they all happen to be during a time when everybody thought things were going to get a lot worse. I mean, look at some of these times. 5 of them were in 2008 during the fall. 2 of them were days just after the bottom in March of 2009. And the others were in the middle of the pandemic, near the lows of the market. In fact, March 24th, that was the first day of the turnaround of the pandemic market. Now, if you told me the headlines without telling me what the stock market's doing, I'd probably tell you that, hey, I'd want to be out of the market too. Nobody can time the top and nobody can time the bottom. And the data shows that just by missing 10 days in the market, your returns could be cut by more than half. In fact, taking it a step further, Bank of America looked at the impact of missing the best days in the market and the worst days. And they looked at every single decade going back to 1930. So the first thing they looked at is how you did if you just stayed invested in the S&P 500 since 1930. Now, that would have given you, if you just bought the S&P 500 in 1930 and let it ride up till now, that would have gotten you a return of 17,715%. However, if you miss just the best 10 days per decade, so you missed 1 day a year, essentially, 10 days out of an entire decade, your return would only be 28% during that entire time frame. Now, I know that that's going to be hard to do just to miss those days, those best days. Now, if you were able to just time the best and the worst days, and you didn't invest in either of those, your return, it would have been better. It would have been up to over 27,000%. Most people think about selling after we've experienced many of the worst days. This brings us to our second investment strategy that retirees almost always regret, and that is halting their contributions to their retirement accounts during a bear market. Now, I get it. If you're watching this, you're probably thinking, my account's going down, Johnathan. I'm tired of throwing good money at bad. I know this contribution is going into something that's already sinking. The first thing that you want to ask yourself is, were you contributing to your 401k last November during the market at its high? Well, if you were, the reality is that is the period that you were at the most risk. Market was at all-time highs. If you're a long-term investor or someone who has years to retirement, This is actually what you want. You want the market to go through periods like this, so you have an opportunity to put money to work while stocks are lower. In fact, there was a great article by Smart Asset that showed what halting contributions to a retirement account did during the 2001 bear market and the 2008 bear market. In this scenario, each investor halted their contributions for a year, and they showed that in 2001, that investor who halted their contributions missed out on over $33,000 of gains, and the 2008 investor missed out on over $56,000 of gains just because of 1 year. Right now, the Dow Jones Industrial Average is just a little over 29,000. How nice would it be to be able to buy the Dow at 13,930? If I told you you could buy it at that, you'd probably say, I'll take it all day long. But when you look back, that was actually the all-time high of the Dow in October 2007. So knowing we went through 2008 and the beginning of 2009, the last thing you want to do is limit your future gains because of investment decisions that you made when the market has already sold off. And that leads us to our third and final investment strategy that retirees almost always regret. And that is putting a large sum of money in a variable annuity after the market's already sold off. Now, I've seen this countless times. Now, trust me, this isn't me telling you that annuities are bad or that if you bought one, you made a mistake. This is just looking at the experience that I've had working with retirement investors over the past 15 years. You got to remember, annuities are insurance, and it's insurance for your retirement savings. Now, you wouldn't buy insurance for your house after it burned down. Now, annuities are great for people who understand that they have a very specific purpose inside of a portfolio. I kind of equate it to this. If I was going through a tornado, I would rather drive a tank as opposed to my car. Now, if I'm trying to get somewhere quick, a tank is the last thing that I would want. What I've seen people do is they buy these investments because of the safety that's provided, but when the bear market eventually turns into a bull market and there are new highs in the market, variable annuity investment performance typically lags, and that's typically due to the higher fees that annuities have. Now, depending on the investments and riders that you have on a particular annuity, the average can run over 3%. So looking at the impact of a 3% fee on a portfolio versus a more common 1% fee, the difference over a 20-year time frame is staggering. In fact, that insurance could cost you over $255,000, assuming you made an 8% per year return. Like I said, I'm not saying that annuities are bad. If you're buying them for a guaranteed stream of income or an enhanced death benefit or even a long-term care rider, they could be a great benefit to your retirement portfolio. But if you're buying an annuity and you expect it to perform in the future in an up market like a traditional investment, that's where I've seen retirees regret that purchase. And the hard part about investing in an annuity is that they often come with very long surrender periods. So it's not as if you can just buy it today and then sell it in a year or two, because typically you have to hold it for a long period of time, or else there's a surrender fee that you have to pay when you liquidate. Nobody knows where the market's going from here, and it could get a lot worse than it is today. But if retirement is going to last you decades, this is going to look like a very small period of time during a very long retirement. And the last thing you want to do is look back at this time and realize that you made an investment decision that impacted you for decades to come. If you're concerned about your portfolio, or you don't know really where you stand in regards to your retirement goals, check out the link in the description where you can schedule your free retirement assessment so you know exactly where you stand in regards to your long-term retirement goals. Our firm is here to help put together a comprehensive plan for your retirement so that when you look back, there aren't any decisions that you made that you regret. If you found this video useful, hit the subscribe button. We appreciate you supporting our channel, and make sure that you check out our weekly podcast called The Retire Once Show. Once again, my name is Johnathan Rankin. Thank you so much.